All right, let's just jump right into it. There is something really weird happening in the market right now, isn't there? You look at the screen, stocks are hitting all-time highs. But then you listen to the news, you talk to people, and it feels like everyone is braced for a crash. It's this huge disconnect, and frankly, it's got a lot of investors just sitting on the sidelines, totally confused.
So that's the big question we're going to tackle. What is going on? How can both of these things be true at the same time? Now, while most of the experts have been calling for a recession, one guy, market strategist Tom Lee, has been one of the very few consistent bulls out there. So we're going to break down his argument because it's a really fascinating way to understand not just what's happening, but why it's happening.
To really get a handle on Lee's bullish case for the future, we first have to go back and figure out why he thinks pretty much everyone got the recent past so wrong. He argues that all this pessimism, all this bearishness, it was built on some pretty big misunderstandings about how the economy actually works.
Okay, let's break this down, because this is super interesting. First up, the yield curve. Remember that? Everybody and their brother was screaming recession, but Lee's take was different. He said, no, you're misreading it. It's just a signal about short-term inflation, not a five-alarm fire for the economy. Second, everyone was stuck on the 1970s. They pulled out the old stagflation playbook and just assumed history was repeating itself. And third, and this is probably the most important point, they just completely underestimated how tough and adaptable companies are. They kept delivering strong earnings, defying all the gloomy predictions.
So, if the old bearish models were flat out wrong, what's the right way to look at the market? Well, this brings us to the core of Tom Lee's whole argument, something he calls the supercycle.
So a supercycle, it's not just a trend. Think of it more like a massive, decade-long story that's driving everything. And here's the wild part. All the way back in 2018, Lee's team pointed to a coming global labor shortage. Now, that might sound kind of boring, but they predicted it would be the exact spark needed to set off an AI investment boom, as companies would have no choice but to automate. And well, look around. That is exactly the world we're living in right now.
Of course, the second you say AI boom, I know what you're thinking. Dot-com bubble, 1999. It's the ghost that haunts every rally, the #1 fear out there today, that this is all just a big party that's going to end in a spectacular crash. But when you really look at the details, the comparison just doesn't hold water. And this slide just lays it out perfectly. The dot-com bubble was all about speculation. Companies spent billions laying fiber optic cable, and at the peak, 99% of it was dark. It was just sitting there completely unused. Today's AI boom is the total opposite. It's about immediate use, real results. Every single GPU is being used, 100% capacity. Seriously, if NVIDIA could magically make 50% more chips tomorrow, they'd be sold out before lunch. This is a boom driven by real, intense demand, not just hopes and dreams.
All right, so if the fundamentals are this strong, why is everyone still so nervous? A huge piece of the puzzle comes down to how people are positioned. The pros, the big institutional money managers, they got caught completely flat-footed. Get a load of this number. A staggering 80% of institutional fund managers are lagging their benchmarks this year. According to Tom Lee, that's the worst performance they've had as a group in 30 years. They basically bet the farm on a recession that just never showed up, and now they are way, way behind.
And this quote from Lee really captures the urgency of the situation. These managers can't just go to their clients at the end of the year and say, oops, we missed one of the biggest rallies ever. They're in a mad dash. They have a very, very short window to fix this, which means one thing. They have to buy. They're going to be forced to chase this market higher into the end of the year.
So, this whole situation sets the stage for what could be a really explosive end to the year. All this money that's been hiding on the sidelines is about to come rushing back in. So where does Tom Lee think this all goes? Let's take a look at his price targets. So his first big call is on the S&P 500. You combine that institutional chase we just talked about with the underlying power of the AI supercycle, and Lee gets to a year-end target of 7,500. And just to be clear, that is a major rally from where we are now, all powered by that sideline cash being forced back into stocks. And in Lee's world, a rally like this doesn't just stay in the stock market. He sees this creating a broad risk-on environment where everyone is chasing returns. You add in a Federal Reserve that might start easing up, and you have a perfect storm for assets like crypto. This is what leads him to his really bold call for Bitcoin, a potential move to $200,000. But he actually thinks the even bigger opportunity might be in Ethereum. And the reason is simple. Wall Street is finally getting serious about putting real-world assets on the blockchain. We're talking stocks, bonds, you name it. And the platform they plan to use for that is a smart contract blockchain,
which means Ethereum. So that's where he sees growth expectations really starting to fly, with a potential target of $12,000 by January.
Okay, so hearing all of this can be pretty frustrating if you're one of the many people who's been sitting in cash, feeling like the train has already left the station. So what do? What's the playbook for getting back into the game?
Tom Lee has this really clear 4-step plan that's all about taking the emotion out of it. Step 1, accept it. Just admit that sitting in cash was a mistake and move on. Step 2, commit. Decide you're getting back in and stop trying to be a hero by timing the perfect dip. Step 3, execute. Start dollar cost averaging. Just invest a fixed amount of money every single month for the next year. And finally, step 4, reestablish. The whole point is to just methodically rebuild your position so you're back in sync with the market.
So, if you had to boil down all this advice for the next 12 months into a single sentence, what would it be? Simple. Buckle your seatbelt. Lee is quick to point out that even in the strongest bull markets, we've had massive, scary corrections almost every single year. So the trend may be up, but the ride is going to be bumpy.
And that really leaves us with one last big idea to chew on. People spend so much time and energy trying to predict and prepare for the next correction, but they often lose way more money doing that than they ever would in the correction itself. So in a market that's just full of noise and scary headlines, Tom Lee's whole thesis really makes you wonder, is the biggest risk you face really a market correction, or is it simply a lack of conviction?